One of the biggest traders' asset is the conviction. Not just the conviction about which direction the price would go, but the conviction on when the easy mode goes into the hard mode. And in today's video, since we have Jerome Powell speaking on Jacksonhole event at 10 a.m. Eastern Time, we gonna see if this easy mode for the next 3 weeks until the CPI print is gonna stay or it's gonna be gone, and what does it mean for your portfolio and how you can hedge. A very interesting year ahead. Let's go. Good morning, good afternoon everyone. My name is Russ, and in today's video, today we have Friday, Jacksonhole event, 10 a.m. New York time. A very interesting day ahead, and moreover, not just a day, but a couple of weeks where we could consider, okay, that's an easy mode right now. Fed gonna cut. Is that gonna be a series of rate cuts announced today, or it's gonna be a 50 basis points cut? We don't know yet. Based on the CPI, based on the September data coming in, unemployment claim, we would see. But I think there are several more data points and information that we need to consider. With all that said, let's start. A new article on Wall Street Journal just came out, and if you follow me, you know that I put a lot of attention to those articles thanks to Nick T. Mirage, and other Fed officials that often give the hints to us where they would go. And this quote, I don't want you to spend the time reading the entire article. It's actually very lengthy today, but what really struck me is this quote. Broadly speaking, the Fed faces two paths for the coming month. Under one, officials could cut rates by a quarter point at each of their next few meetings and then dial up and down the size and speed of reduction depending how the economy fares early next year. And if the economy enters a sharper slowdown, they could cut rates in larger half-point increment to get interest rates closer to 3% by next spring. Super important piece of information that we always need to consider, and this number one is a jobless claim. It's kind of small tick up, but for me, for now, the next week, it actually looks good. We normally take it step by step. For those who was watching my video, you guys remember it. You know that I like to look at the market in slices of time periods, and for now, it is actually quite bullish based on data and technicals that are in front of us. Number two, as I said, Fed in the Wall Street Journal is giving us the hints of what's gonna happen, what's Powell gonna deliver. And they said that's what likely happening, whether he delivers the message or not. We are going to see the series of rate cuts. We don't know if he's gonna be confirming them to come at a particular pace, or he would try to reevaluate them on a case-by-case basis, but the Fed officials are speaking about cuts. And the third thing, out of nowhere, two Fed officials in the last week came out and started speaking about reduction of quantitative tightening and bringing quantitative easing. Does it sound particularly good to me? No, because it scares me. It brings inflation fears back into the market. But inflation is also, of course, in profits and revenues. So the number go up. Narrative is gonna potentially also give more liquidity into the markets. And who's gonna benefit the most out of it? Well, the inflation hedges. Gold, silver, Bitcoin. Is it so easy like that? And for the next 3 weeks until the CPI comes out, we can just enjoy the market ride together with miners, silver and everything? I don't think so. Why? Well, because of two reasons. First of all, and now we need to go into the charts. Looking at S&P 500 index, it is still following my plan, and my plan is to take those highs, to take those early shorts, and then maybe this is just the smart money exiting. What do you think, guys? What do you think? To which degree it can be an engineered pump? Because it too quick of a move to come back to those lows, make this 10% way faster than we were actually dropping. Normally, I prefer to see something a bit more standard for the markets. You know, as we like to say, stairs up and then elevator down. Here we had elevator up. This move was quite aggressive for my liking, and it made me feel or have an intuition that can be also a smart money exiting on retail, being excited of us printing the new highs. And if you remember, I've been outlining this scenario from the month of May, when I explained to you how the stock crash would start to happen. But Russ, we're talking here about the tech stocks. We're talking here probably about NASDAQ and also to a certain degree about Russell 2000, even though, as Nick has mentioned on his previous video, the rate cuts, of course, gonna benefit the small and mid caps much more than the large caps who have an easier access to capital. Does it mean that metals also gonna suffer? Well, yes, to a certain degree. This huge DCL in the stocks can bring the fear into the other markets as well, even into the inflation hedges. You know, when these huge sell-offs are starting, please keep in mind that portfolio managers are normally sitting on the various ranges of an asset classes, and when they start taking profits on one of the particular asset classes, they often tend to close their portfolio with this current returns that they have, basically quitting everything. It doesn't make sense for them to stay there and bleed on other asset classes. So yes, this profit taking can be contagious. The profit taking can start having the domino effect, and that's the reason why I don't yet recommend you to go full in on silver miners. I don't yet recommend you to go full in on any asset class, and that's why in the Telegram group I've been outlining I'm still sitting on 50% of cash, and I'm not in rush to take the position just yet. So despite everything is pointing out to be very bullish, including my macro model, I am still very cautious here, because that intensity and the speed of this pump gives me the hints that it can be artificial. And what is the first chart that I would like to evaluate if I would love to see? Are we having a lot of headwinds against our asset prices? Do we have a lot of pressure on the stocks? Pause the video for a second and answer yourself. What is this one chart that you need to start your day with? What is the biggest market in the world? Yes, correct. That's the Forex market. And what's the easiest way to assess Forex market? Of course, guys, it's DXY. And if you remember, DXY is the basket of currencies that represents the dollar strength, but includes the dollar versus others. And of course, if you're gonna start analyzing them one by one, you can see, all right, British pound. Of course, nothing goes in a straight line. Of course, we're still in an uptrend, but looks a little bit like this uptrend is getting exhausted. The British pound is gonna fall down, meaning dollar might go up from here. Let's look at Euro USD. Are we seeing the same picture? Yes. We start breaching divergences here. I would expect to retest and think at this rate of 1.1 or maybe 1. Itself, we've been down for weeks consecutive frame here, and what does it? Without too smart, I see that we are holding this level, yellow line of 101.3. This is the line that here for more than 2 years since our project. All this I said really, I spotted at top of dollar 114.8. I remember, and we all this correction down to the lows of 101, and this is where we are right now. And if you remember, if you've been watching my videos, you of course remember that most of the markets are ranging and not trending, and that support, don't expect the support to be touched and immediately vanish. No, we need to have a bounce first. We need to have maybe 2 or 3 bounces. So what does it mean for the asset prices when DXY is gonna bounce? And this is something, guys, people are asking me sometimes in the comments, but 4 weeks ago you were saying everything is good in the market and now you change your opinion. Guys, no one can predict that. And of course, I've been never saying, I wanted to highlight it because there was one comment in the last video, someone said, but you said US economy is doing great. I never said that US economy is doing great. I said that US economy is doing okay on steroids, which is of course the inflated asset prices and so on. I would not go into macroeconomy right now, but my main outlook here is quite clear. I'm looking for the recession dump. I'm looking for the dump of at least 20%. And that's why it is so not easy this year. We cannot just buy everything and wait. Some people are saying, Russ, there's too many signals. I can't cope up with that. I have a job. Guys, we are not in 2020. We are not in 2021 when you can just buy Zoom or Peloton and then expect the stocks to go 10x. It is a completely different macro environment, completely. And I'm speaking to multiple portfolio managers that are managing billion plus, and they said, Russ, it's the hardest year we faced probably in the last 15 to 20 years, probably since the great financial crisis of 2008. on that magnitude of the timeline. So please also don't go too tough on yourself if you are seeing that some things are not unfolding very easily, that you need to enter the position and exit and enter and exit at break even again, trying to catch a ride. Yes, this is normal. This is very normal in this environment, but everything is pointing out to a fourth turning. The fourth turning is the model, not just macroeconomical, but also social and political, that highlights that we are entering the last stage or the winter of our long 110, 120 year long debt cycle. And we are entering the very end of this fourth turning. So yes, indeed, everything is due for a huge reset, including the financial markets. And that's why for me, S&P 500 is extremely overextended. It needs to come back and touch its 200-day moving average. And I'm afraid more of a double top formation. And this double top will not be easy. This double top would actually first look like we are breaking out, and then it would lure the retail in. And once again, guys, you don't need to worry so much. We are very well positioned for that. We are very well protected. We are very much in silver and other commodities. For those who don't know my positions or wants to follow where I'm doing, I'm actually posting intraday alerts every day in my Telegram group. I'm gonna put the link in the description down below. I think it's like the cheapest ever subscription available online, and I'm doing everything completely for free, just only for the Nix newsletter subscribers, which is coming now at around $30 a month. I honestly don't know what the prices are anymore, but I also doing everything myself for free for the subscribers. I'm not doing the things for money. I just want to share. I want people to be protected. I also feel very bad when people, especially the new investors, the retail investors so-called, are becoming the victims of the smart money engineered pumps and dumps. And we had a lot of those in the last 4 years. If you think of those, if you look back into the macro environment and you see how this whole thing unfolded, first of all, extremely easy money, COVID crash, quantitative easing, hyperinflation, that over-tightening, that all pretty much was a very huge attack on the middle class and the small businesses. And it's a sad for me to watch. And that's one of the reasons why I'm doing what I'm doing. But enough talking. Let's look into other markets. I just wanted to emphasize, you're looking at DXY here. Be very cautious. For the next couple weeks, I'm going to be traveling in California and Nevada, visiting some friends and a bunch of other interesting people in the US. So I prepared the series of videos that's going to be starting from the next week onwards. And it's so funny, one of the video I was recording it based on auction market theory that I would announce, and I wanted to see if the trade is going to actually do well or not. I already recorded the video, and then I realized 4 hours later that this trade hit 5-1. So it's a good one, guys. It's almost, I would say 80% probability, but you need first to watch a couple of theoretical videos about what is actually auction market theory to understand how to apply those trades mindfully. I also realized a lot of people, they look too much on various oscillators and indicators, but they actually don't understand the real deep truths or the mechanisms behind why price moves. And this is super important, guys. Very often I look at the chart, I don't need a single indicator. I can just look at the candles and already have the game plan from here. I would see where the liquidity resides. I would see maybe with a little bit of a help of a volume if the move has been sustained or not. But no, all in all, next 3 weeks you would start seeing those videos, so please stay tuned. Of course, you would see more of Nick since he is not traveling. And one last thing for today, let's actually look at crypto. And the first chart I start here with is Bitcoin dominance. It starts looking like, to me, we might have one more small bounce here and a dominance. I don't think we have much higher than 58 to go. Maybe one little shoot up, something like that. And then I would really look forward for us to bounce a couple percent down on Bitcoin dominance, and that will be an extremely fun move for the alts. I personally gonna trade a lot. I think it's also very much aligned to where Ethereum BTC is standing up right now. Potential to print this, let's be a bit more accurate, this W formation, and you know, your invalidation point is very low, just that that previous low. So something very nice here, just to get back to our W. It's already almost 6-1 trade. So of course you can imagine how alts and how higher betas to ETH are going to react if Ethereum to Bitcoin is making this move, you can start already seeing that Ethereum Classic, which is normally acting sometimes a little bit more volatile as Ethereum due to the smaller market cap, is about to break out from the W formation. So starting to make, how we call it, if you missed my previous video, market structure break. So maybe it gives us a higher high here, and then we can retest. And we can retest this breakout zone, and that can be a very nice trade since we had a lot of inefficiencies here. Maybe not on a daily time frame, because you can see that this candle particularly had a very long week. But if you go on 12 hourly or 4 hourly, you can see there are multiple fair value gaps here. For example, this FVG, I would like to, to see this fair value gap tagged. And for those who wants to try scalping alts, especially when you see the confirmation from Bitcoin dominance falling down, I keep the link here in the description down below. Bybit gives 500 USDT trade for free. This is personally my preferred platform because I can also trade spot completely without any fees on USDC, which is not available. Unfortunately, USDT trading is not so easy available for European users. And what's so important that you can put stop loss, take profit in any spot trade before this trade is allocated. So since I have a relatively large portfolio and I will be partially traveling, I would also consider taking some of those trades on spot. Some of them, of course, I would like to do on leverage. And why leverage? Well, because it allows the most seamless integration with Steelstraight, and you don't even have to use leverage. You can just, of course, play like I played yesterday on, less than 0.3x leverage, just entering the small position. For example, on SUI yesterday, I saw that we are breaking out from that market structure break. I put my limits here around 0.85 and something between 0.85 and 0.86. I made, let's say, a small order, 30,000 with 10 orders, and I scaled in here and I exited couple of hours later. So one of those things that you can do, of course, they're much easier to be done on future contracts, and that's why when I say leverage, it doesn't mean that you have to over leverage your account. It just means that you deal with perpetuals. So yeah. Guys, with all that said, I wish you an amazing end of the week. Touch the grass. Much love to you all, and I see you soon. Bye.